Hello, I'm Anastasia Amoroso, and this is Beyond 60/40. On this new show, we take a deep dive into the alternative investment space and speak to industry leaders who share their expertise and insights on market trends, the macro environment, and investing opportunities. Today, we begin with my market pulse snapshot and the one thing in particular that caught my attention in private markets this week. Next, Ed Testerman of King Street Capital Management joins me in the studio to discuss private credit and where he sees opportunities in the current market. Then we sit down with iCapital's Head of Research and Education, Kunal Shah, to talk about the private equity secondaries market and what he's seeing today. And finally, I'll share 7 critical considerations to take into account when selecting a private equity manager. Let's get started. 2023 has been a roller coaster ride with the collapse of regional banks, tightening credit conditions, and ongoing market volatility. In today's Market Pulse snapshot, the one thing I'm focused on, though, is private equity valuations. For months, the question was being asked, when will the private market valuations correct to follow the correction that played out in the public markets last year? Well, the answer is now. PitchBook's latest data shows that the private equity multiples have fallen so far in 2023. For example, the enterprise value to EBITDA, EV to EBITDA multiple on private equity purchases fell from the peak of 12.2 times we saw in 2020 to 11.1 times in the first quarter of 2023. Notably, the multiples paid on corporate acquisitions are even lower, falling to 7.7 times in 2023 from the peak of 10x in 2021. Also, one other way to look at valuations is to look to the enterprise value to revenue multiple. This is a broader measure because it captures companies that have yet to show profitability. As a result, this measure does a better job of capturing yet to become profitable companies, that is, unprofitable tech. Indeed, it shows that the median EV to revenue multiple on private equity buyouts fell to 1.7 times throughout the first 3 months of 2023, which is down from 2.5 times in 2021. And finally, one last observation. The use of debt in private equity transactions has been declining. The leveraged buyout debt to enterprise ratio is down to 45% in the first quarter of 2023 from 50% in 2022. This, of course, makes a lot of sense given the sharply higher interest rates. But here's the good news. As valuations are in the process of correcting, activity in deals, whether they're debt financed or not, that activity is picking up. The first quarter of 2023 saw a rebound in estimated deal value back towards $250 billion, or 11.4% higher than the fourth quarter of 2022. And there you have it. This rebound in activity amidst the valuation correction is the one thing that's catching our attention this week. Coming up, King Street's Ed Testerman joins us to talk about private credit and capitalizing on dislocations he's seeing in global credit markets today. My first guest today is Ed Testerman, partner at King Street Capital Management. King Street has been in the alternative space for over 25 years and is a leading global alternative asset manager specializing in multi-strategy credit investing. Thanks so much for joining me in the studio, Ed. King Street has a long track record since 1995, and we know that at King Street you specialize, amongst many things, in dislocations. And speaking of dislocations, we've got the Fed that has raised interest rates by 500 basis points. So we've got rates higher, we've got spreads wider. So my first question to you is, where is the dislocation today? Where are you finding it?
Well, first, thanks so much for having me. At an index level, it's interesting. For high yield and investment grade credit with spreads at 450 and 150 basis points, we're not really seeing much in the way of dislocation in those markets. Now, on a single name basis, when you peel back the onion, we oftentimes see dislocations at various points in time throughout a cycle. So if you just look back to March of this year, right, within a 10-day period, we saw Silicon Valley Bank effectively fail and the market lose confidence in Credit Suisse. That was a material dislocation that took place in a very short period of time.
Yeah, and if I may, for those who are not familiar with, how do you play these sort of situations, to the extent that you're able to share, how did you, invest in that particular dislocation?
Yeah, so not to get into super specific details, but from a underwriting perspective, we spend a lot of time looking at the individual balance sheets of the banks from a fundamental perspective, working with our traders to understand where we can actually source liquidity in the markets across bonds, and on the capital market side, engaging with various counterparties to understand where we could source risk, and then from a legal perspective, really understanding the docs, how the various securities interacted with each other, to understand where the best place in the capital structure would be to deploy capital.
And, and a lot of people still worry about the banking crisis, right? It seems like it's come and gone, but still there's this concern in the market that maybe it's not actually gone, maybe it's still playing out. So were you also finding opportunities in other parts of the banking system where you did see that dislocation? Are you still finding those opportunities there?
I'd say there's probably less in the way of acute opportunities, within the banking system today. Now, that can obviously change over time, but when we look at, where we're finding opportunity and dislocation today, I would point to the leveraged loan market. As we take a step back and think about that asset class, we're seeing dislocations from both a technical and a fundamental perspective. So when we think about technicals, CLOs represent 70% of the leveraged loan market today, and those are rating sensitive vehicles.
Right.
And when we look under the hood, approximately 5% of holdings in CLOs right now are CCC rated. Now, CLOs have a sensitivity to owning CCC loans, and if they ultimately get above 7.5%, there's a real technical where they're forced sellers of loans, and we've started to see that play out. Now, what's even more interesting is 25% of the leveraged loan market is single B. So if you assume that a quarter of single B credits are downgraded to CCC over the next year or two, that CCC basket within CLOs goes from 5% to 12%. So
which would generate the forced selling.
Correct, which would force pretty massive selling across that ecosystem. At the same time, from a fundamental perspective, we've seen interest costs double for a lot of issuers in the space. We're seeing an upcoming maturity wall of almost $300 billion over the next 3 years. We've seen in deals that have gotten done over the last several years, less in the way of equity and subordinated debt cushions. So LTVs are actually higher than they have been in the past. And credit docs that are fairly weak. And so covenants that can ultimately be taken advantage of in terms of coming up with new liquidity solutions or other liability management exercises that are dilutive to existing loans.
So you think the broadly syndicated, publicly traded leveraged loan market is not just a dislocation, but this is a potential distressed opportunity. So you think there's going to be higher defaults. And I guess my question is, how are you approaching that opportunistically? Are you shorting parts of it? Were you finding credits that are particularly attractive? How are you thinking about that?
Yeah, so there's $250 billion of levered loans today that yield north of 12%. There's 125 billion of loans that trade less than 80 cents on the dollar. So as we think about the true distressed opportunity set within the leveraged loan universe, we're getting very excited. Now, the reality is you've got to be very selective. You've got to be very focused on your individual security underwriting, because there is quite a bit of dispersion in the leveraged loan market right now. Just to give you an example, we're very focused on the healthcare sector as an example.
Okay.
15% of the leveraged loans in the healthcare sector are distressed.
15%.
Right? And when I say distressed, they're either trading at greater than 1,000 basis points spread to treasuries, or they're trading at a dollar price lower than 80 cents on the dollar. Now, when I tell people that, people are typically surprised, because healthcare is viewed as defensive.
Indeed.
Right? Healthcare is typically acyclical or countercyclical. But the reality is we've dealt with an environment in that sector over the last 2 years where labor costs have inflated pretty massively, but there has not been a corresponding increase in reimbursement from government and commercial payers for those healthcare service providers.
Right.
And so margins have taken a pretty massive hit. Liquidity has come under pressure because of some of the issues I described earlier around interest costs and otherwise. And so that's created what we think is a really compelling opportunity at a time where we think margins are actually troughing for a lot of the companies in that space.
It's such a great point about healthcare, because a lot of people think of it as pharma and which is defensive, but you're right, the margins in the services sector within healthcare are so thin, so it makes sense to kind of approach that as an opportunity from a credit perspective. But a lot of people, I feel like, are flagging the concern about the leveraged loan market, but maybe there's not been as much concern about the high yield market. So, and when I looked the other day at sort of the percentage of CCC, high yield bonds that are trading, let's say, below 85 cents on the dollar, it's a really high percentage. I mean, I'm talking like 80, 90%.
Yep.
Is that an anomaly? Is that an opportunity?
Yeah, so we oftentimes at King Street say that the worst go first when we enter a distress cycle. And what that means is the worst companies ultimately end up filing for bankruptcy first. To give you a sense, in the leveraged loan market to start this year, there's been a handful of defaults. Loan recoveries have been 20% on average. That compares to historical levels of north of 60%. So that gives you a sense of the quality of companies that we're seeing default. Within the high yield space, the ratio of triple C spreads to double B spreads are in the 96th percentile of levels that we've seen over the last 20 years.
That's so that
gives you a sense of the dispersion.
Unprecedented almost.
Yeah, the dispersion that we're seeing within the high yield market and the quality of some of those lower quality bonds in the high yield space. And so our expectation is, yes, we are going to see more defaults over the next several years. Our expectation is a lot of those will ultimately end up shaking out in the leveraged loan space rather than the high yield space because of, you're talking smaller businesses, typically lower quality businesses, when you compare the two. And so that's ultimately where we think we'll see a much larger default cycle. But there will be opportunities in high yield as well.
Right. So while you're sitting and patiently waiting for the default cycle to fully unfold, I know that taking some selective shorts is also part of your approach. So give us a couple of examples of what are you particularly negative on now, so much so that you're willing to short it.
Yeah. So there's three primary areas that we're spending time on the short side. The first is trying to identify companies that we say are secularly challenged. So they either lack pricing power or they're experiencing volume decline. So their revenue is not able to grow as fast as their expenses. And so they're experiencing margin pressure, similar to what we've seen in the healthcare space, but that's a very temporary issue. These secular decliners are businesses that we think margins will decline consistently over time. The second bucket are businesses that are very cyclical in nature.
Right.
So their securities are not pricing in a high probability or even much of a probability of a recession. And we think that, based on where historical trading prices have been in those securities, that doesn't make a lot of sense to us. The third bucket would be capital structures that are highly levered, where we're seeing the potential for real cash burn from the individual companies. And we think there's going to be a real issue ultimately being able to refinance those capital structures over the next several years if they have near-term maturities.
Yeah.
Now, to give you a sense of some of the industries that we're focused on, we use broadcasters as an example. Broadcasters are ad-exposed businesses, highly cyclical, and they're losing share to streaming. So that's a good example of kind of the cyclical and the secular challenges within one business. On the cyclical side, we're short, airlines and autos and certain names within home building and building products. So just to give you a sense, those are some of the types of situations that we're focused on.
Well, it sounds like there's no shortage of shorts to go around. These are great examples. But to kind of go back to where we started, which is the regional banking crisis, and what does that do to the credit environment? I mean, you look at what those regional banks are doing in terms of lending. They're paring back that net lending pretty severely. You have commercial and industrial loans that are net lending is now in negative territory for the last four-week period. Same thing for CRE. So what does that do to the credit environment and maybe opportunities? And specifically, can private credit step in and fill the void that maybe might be left by some of these regional banks?
Yes. So tightening lending standards, not new, right, amongst the broader banking sector, but more specifically in the regional banking space, much more of an acute issue today than we've seen in some time. And so that creates issues for companies that need to address their capital structures. It creates real opportunity for private credit providers. And so if you just take a step back and think about the real estate space as a perfect example, right? There's $1 trillion plus of CRE maturities coming due in the next year. That was going to be a problem from a refinancing perspective before we faced a regional banking crisis in March of this year. Right? Regional and local banks represent 30% of CRE lending. So you have a big chunk of that market that is pulling back on their lending, and that opens the door for firms like King Street and other private credit providers to step in and provide capital solutions to a market that is really challenged, right? Where cap rates are higher, valuations are lower, and you have real balance sheet issues that we think we can step in and provide really interesting capital solutions for.
I guess all the potential for distress in commercial real estate and the fact that regional banks are pulling back is good news for private credit. And private credit is good news for real estate, perhaps. Well, Ed, this has been fantastic. Thanks so much for joining me at the desk today and for sharing your perspectives on the state of the global credit markets, including private credit, which really appreciate that. Next up, we sit down with iCapital's Managing Director and Head of Private Markets Research, Kunal Shah, to discuss how the private equity secondary market can offer unique portfolio benefits and diversification for investors. My next guest is Kunal Shah, Managing Director and Head of Private Markets Research at iCapital. Thanks for joining us, Kunal, for our inaugural episode of Beyond 60/40.
Thanks for having me.
It's great to see you. And you recently published the article that takes a deep dive into the private equity secondary funds. And not long ago, a lot of investors thought of this as a very niche asset class, but it's been attracting a lot of investment interest and also has been more accessible to the market participants as well. So my first question is, can you talk to us about some of the advantages of PE secondaries and how do they help investors manage what's otherwise an illiquid private equity portfolio?
Yeah, of course. There's several advantages of investing in secondary. And so let me break that down and I'll give you a couple of examples of how to think about it. A secondary fund is a fund that you buy interest in midway through its life cycle. So let's take a step back. When you raise a private equity fund, you're raising that as a primary capital. That's year one, which has 5 years of investment period and 5 years of harvest period, typically. It can change, but typically 5 years on each end. And that 5-year period of investment period that we refer to comes with capital calls and sort of fees on capital call that you charge as well, which leads to J-curve element of it. Which, in other words, capital goes out of your pocket, and it doesn't come back until year 4, year 5. And so all of a sudden, it becomes a hockey stick-like scenario. But the first few years, you experience negative cash flow.
Right.
And you experience negative return, at least in the first year, because the assets are marked at cost, at least for the first year, year and a half. And so investors experience that in a primary fund. In secondary, you don't experience any of that or almost none of that because you're essentially buying that in year 4, year 5. These are seasoned portfolios at that point, seasoned assets underneath, and you essentially are capturing distributions faster. So it mitigates the J-curve piece pretty quickly. The second is you get diversification benefits. You're getting diversification through a seasoned portfolio around sort of diversification by vintage year, diversification by strategy, by region, by manager. And again, that has significant benefits as well. We always tell to investors, if you're new to this asset class, start with secondary because of all the diversification benefits as well as the J-curve benefit. And the last one is a blind pool risk. You're buying a seasoned portfolio. You're buying something that is already in the ground. In my example, if you're buying something in year 4, year 5, you know what you're buying. The underlying investment manager has already made some investments, which are very, very appealing for us to underwrite, and that provides a transparency that is very appealing.
Yeah, Kunal, and one of the things when you're buying a secondary transaction, well, you know what the underlying companies are, so therefore you can price them. And so one of the other terms in P secondaries is this discounting mechanism. You're not buying this at 100% of net asset value of some of these companies, but you're buying that at a discount. So what is a typical discount in P secondaries versus what we're seeing today?
Yeah. So there are two ways to make money in secondaries. One is buying assets that will appreciate from here on. And the second is buying those same exact assets at a discount. In a normal environment, discounts have ranged around 10 to 15%. So if you rewind this 3 years ago or 4 years ago, you're getting essentially good assets at 90 cents on a dollar.
And by the way, why is it that you're getting them at a discount?
Because in a normal environment, everybody has a rosy expectation, right? Everybody expects the market to continue performing, the assets to continue growing, the assets to appreciate, and exit activity, in other words, distribution coming back to you on a regular pace. In a market like right now, all of a sudden, the IPO window is shut down. So you do not know when the money is going to come back to you. I need to apply a discount for that uncertainty. Now I know the potential seller is selling for a specific reason. So I can smell some stress. Well, if there's stress in the market, let's apply some discount for that as well. And then the growth uncertainties are out as well. I do not know what the growth projections are. We are in a very difficult environment. Fed just raised interest rate again. And you're talking about an environment where the growth is muted or likely to be muted for a while. How do I get to the same return potential that I have historically done with all those uncertainties? The only way to do that is to apply discount to those assets and then get to the final outcome that I'm underwriting to.
Sure. You mentioned that the typical discount is somewhere around 10 or 15%, and it seems like we're approaching 20% now. Do you think we've appropriately reset?
We actually are going closer to 25 to 30% now. So the 20%, which was the year-end number that you were talking about, year-end 2022, is now slipping into 2023 at around 25, 30% discount. So look, nobody knows because everybody has a different value on an asset. But I can tell you is putting a historical perspective, during GFC back in 2009, assets were trading at 60 cents on a dollar, so about 40% discount. We are not seeing GFC-like risk right now. So yes, it is slowdown, recession, potentially prolonged recession, but nobody's calling for a GFC-like very drastic scenarios. And as a result of that, discount should be lower than that. I think 25-30% is a good place to be, and you probably will still make a really good investment return out of that.
So it sounds like we are sort of coalescing around this time, potentially being a pretty attractive entry point into P secondaries. But let's talk more about growth in the P secondary market. I mean, it has grown dramatically over the last 10, maybe 20 years. So what do you expect in terms of future growth in P secondaries? How much is invested today? How much more do you think there's an opportunity for?
Yeah. Look, the market, I believe, is going to continue growing. And there are a couple of reasons for that. There's one that is a near-term, more topical thing, and then the second is more broader. So let's talk about the topical thing right now, which is what we are all calling the denominator effect. You and I have spoken about this before, right? Which is a lot of pension funds or insurance companies, they live with a target range to an asset class. They say, I want to invest 10% of my portfolio to private equity. Sure. In a market like right now, when public markets tank, all of a sudden they are overexposed to that. And they have very certain and fixed liabilities. If you're a pension fund, you got to pay your pensioners. And so the actuarial and the investment committees and the boards of all those places do not want you to go too far out without their approval.
Sure.
And so unless you get approval to increase the range, they will ask you to sell. And so there is a forced selling happening in some pockets of the industry right now, which is causing the market to grow. Market has eclipsed $100 billion of volume for the last 3 years. It probably will eclipse this year as well. But the other component there is introduction of secondary liquidity through general partners. So fund managers are increasingly saying, well, my investors are asking for liquidity as well. And maybe instead of them selling this by themselves, let me create some liquidity in what we call the GP-led secondary market.
Sure.
That is growing at a rapid pace to a point where it was about 40 to 45% of the market last year. And so I think both activities will continue running it simultaneously, and both are growing at the same pace. And last thing I would say is just you have to put all this in perspective, the growth of private equity market. Today there is over $5 trillion in private equity asset class, right? So it's natural for hundreds of billions of that to trade every year. Rewind 20 years ago, it was $1 trillion asset class. So it was probably tens of billions of dollars. So you have to apply the same multiple to the growth of private equity market to the secondary market as well.
Sure. Well, certainly a lot of growth potential, but just real quick to sum it up and kind of do a bottom line for our investors, there are certain risks that P secondaries help us mitigate, whether it's the liquidity risk for certain LPs, whether it's the blind pool and the J-curve risk. But, if you're mitigating some of the risks, aren't you giving up something in return? So what are your return expectations for P secondaries versus the traditional P strategies? Yeah,
that's a great question, Anastasia. Yes, like anything, when you're getting something, you obviously are giving up something, to your point. And in the secondary case, I would say that your multiple on invested capital is likely to be lower than in a primary fund. And again, let me go back to my examples that I gave you earlier. A fund that is formed today, year one, has 10 years to develop that sort of capital base and invest and sort of deploy and sort of harvest. That fund historically should give you, if you select the right manager, probably 2.5 times money multiple. So essentially, dollar given gets converted 2 to 2.5 times of the dollar. In the secondary market, because you're buying that portfolio in the midpoint, so somewhere closer to that 2x multiple, you're not going to be able to capture the same kind of money multiple unless you're buying at a significant discount. The step up in the multiple. Exactly. Right. So unless you're buying at a significant discount, you're not going to be able to capture that. But that's okay. Because you're getting money back faster, the other metric that we measure in private equity is internal rate of return, which essentially measures the velocity and the frequency of capital coming in and out of a fund. Sure. And because you're buying a fund that is later in its life cycle, you're actually capturing sort of a higher IRR as a result of that. And so on an IRR basis, you're going to be equal to a primary fund. But on a multiple basis, you're lower. But that's okay, because if you, for all the diversification benefits, reduce J-curve, no blind pool risk, that trade-off is a very, very worthwhile trade-off.
Well, that sounds like a lot of benefits in terms of risk mitigation, and the fact that IR still compares very favorably. That's a pretty big benefit as well. Kunal, thanks so much for sharing those insights with me, and of course, great article on the opportunity in PE secondaries. With that, coming up next, I share 7 critical considerations when selecting a private equity manager. Welcome back. Here at Beyond 60/40, in addition to keeping you up to date on the latest news and trends in private and public markets, one of our goals is helping investors build a fundamental understanding of the alternative investing landscape. Innovative financial technology platforms have opened the doors to private equity investing, but return dispersion is massive in the private markets industry, so the selection of a manager is crucial. Here are 7 critical considerations when picking your private equity manager. First, examine their methods for creating value. Primary value creation drivers include financial engineering, multiple expansion, and revenue or EBITDA growth. And often managers employ all 3. Second, evaluate the investment team. In addition to their experience and capabilities, ensure that the terms of the fund properly align to the economic interests of the investment team with those of the investors. Third, research their deal sourcing and investment process. Are they able to identify and connect with target companies before their competitors? Fourth, analyze their historical performance track record. Has their strategy been consistent, and what has been the true value drivers and detractors over time? Fifth, look at the unrealized portfolio. Determine if the manager has the proper resources to oversee current companies while raising capital for the next fund. 6. Benchmark their performance. A manager's track record may be attractive on an absolute basis, but certain vintage years outperform others. So compare historical performance to other funds that pursued a similar strategy in the same vintage year. And 7th, assess if the investment strategy aligns with the expected market environment of the investment period of the fund. So, with such a wide range of potential investment outcomes, it is wise to do your homework before selecting a private equity manager. For answers to these questions and more insights, visit our insights and education page at iCapital.com. I'm Anastasia Amoroso, and thank you for joining us today, and we'll see you next time on Beyond 60/40.